Hello, everyone. My name is Tanika Mehra, and I am your host today on Wharton Tech Toks. Let's imagine it's 2030 and your car just drove you home on its own. Your AI assistant wrapped up your mortgage negotiations, and a drone stocked up your fridge with groceries you didn't even know you needed. It sounds like science fiction, doesn't it? But it's the world we're stepping into. And today's guest has been partnering with visionary founders, turning this future into reality. Ish Dugal, co founder and managing partner of IronArc Ventures, has over 18 years of experience as a principal investor in the PEVC world and has invested over 500 million in some of the most groundbreaking names in tech, from Anthropic to Scale AI to SpaceX and many more. He's been a key investor in 6 companies that have gone public, and his track record ranks amongst the top in industry. Before founding IronArc, Ish played a pivotal role in firms such as R&N Group and Paladin Capital, investing across industrial tech and semiconductor manufacturing. He sat on the board and advised top venture funds and even serves on the advisory board at the University of Maryland Digman Center for Entrepreneurship. Welcome to the podcast, Ish.
Thanks for having me, Tanika. I'm excited to be here.
Yeah, it's always great to have an alum back on the podcast for students to hear kind of what they've been up to. And you've been at the forefront of some of the biggest tech shifts in recent years. Looking back on your journey of over 2 decades in the world of VC, what got you interested in the first place?
Yeah, it really started when I was in my teens. At the time, .com was happening. These big companies were basically being built overnight. And I used to read Forbes a lot, and I used to see that these new companies and industries were being built and going from zero to being super valuable in a very short period of time. And I said, man, these guys are doing some really interesting things. And wouldn't this be a really exciting career to be a technology entrepreneur? So my initial aim was to start a company and be an entrepreneur. As an undergrad, I studied finance and information systems and got to meet and got to be mentored by the dean of the business school, who actually used to be a venture capitalist himself. And over time was able to basically convince him to send my resumes to all of the VCs he knew. And he was a pivotal person in getting me kind of an opportunity in VC. And the thinking was at the time that it would be a great way to learn how to be an entrepreneur, which is you go into VC or a junior person, you speak to lots and lots of companies, you learn about different industries, and then you can kind of decide what it is that you want to do on the entrepreneurial side. But once I got into the industry and, I got in at obviously the lowest level as an intern, I kind of stayed in the industry for the last 18 years, worked my way up from kind of analyst to partner level, and then started my own firm. In a way, my kind of entrepreneurial journey has come full circle, not so much as a technology entrepreneur, but as a founder of venture capital firm.
Yeah, wow, that's really crazy to think about that you became an entrepreneur in the true sense where you started something from the ground up. And can you talk maybe a little bit more about how the industry has evolved over the last 18 years?
Yeah, it's evolved an incredible amount. I would say, for one, when I started in the industry, this was around 2005 timeframe, it was very much a cottage industry. And I don't know how many VCs were in the industry at that time, but it was probably less than 2,000 individual VC investors. I would say today it's probably 5 to 10 times as many. And the industry has grown an incredible amount over that time period. And technology has changed a lot too. At the time, obviously .com was a big thing. Then things evolved into kind of social media, consumer internet, and mobile. These are all things obviously enabled by mobile communications. Then we've had this huge wave of kind of cloud and SaaS related companies. And now we're going into the world of AI. And my sense is that this wave is going to be bigger than all of the others and maybe even bigger than all of them combined. So it's such an exciting opportunity. I think the evolution has been amazing to be part of. And I think I'm today more excited than ever about the opportunities in front of us.
Yeah, I think that you have like a unique perspective given that you were there across so many different tech evolutions. And you've invested from companies in Series B to expansion stage. How would you say, as the industry is becoming more and more competitive and the stakes have started to get higher and higher, how has your approach to investing changed?
Some of the fundamentals stay the same. So the important things are still the important things. And I would say that all starts with people. Are you backing first class people? I think that is still going to be the case, whether it's a Series seed company or a pre IPO investment. We think a lot about, I think John Doerr talks about backing missionaries versus mercenary entrepreneurs. And we think a lot about that. Are we backing somebody who's truly a missionary and who's doing it for the right reasons and is going to continue to build with the intention of creating a generational company and a large outcome? Because that's how we as investors make most of our money. Considering power laws, there's a handful of companies that really make all the difference in a portfolio and even in the industry. So I think we spend a lot of time thinking about that. And then certainly, I think today we have a lot more data about markets and inflection points than we did in the past. I think what's clear is you want to ride an inflection point and you want to be able to answer the question of why should this company not just exist, but why is now the right time for this company to really make an impact? What you don't want to be doing is kind of swimming against the waves, against the momentum of the market. I would say products have become a lot more complicated and elaborate over the last few years, but the general rules are the same, which is you need to have product market fit and you need to have a really good distribution and sales channel. It's probably more important than ever today because there's a lot more companies and there's a lot more competition. So a lot of companies differentiate themselves either by having a better product or just having superior distribution channels.
Yeah, that's super insightful. And as we are in the AI inflection point, and I think after COVID, really, a lot of these companies have decided to stay public for longer. When companies come to you and they're on the fence on what's the right timing to IPO, and is there ever a scenario where staying private is actually more beneficial than going public? How do you advise founders when they come to you with these questions?
Yeah, I think if you decide that you want to take your company public, I think you have to have built a fort of a business. And what I mean by that is you need to have incredible predictability about where your company is going, at least over the next 8 to 12 quarters, because the first 8 to 12 quarters after you go public is what is going to set the tone with public market investors about what kind of company you're building. And you don't want to disappoint in the beginning. Now, I think the other thing you really have to be able to do is with public investors, you have to be able to tell your story very, very clearly. I think when you're a private company, VCs are more open to giving you a little bit of the benefit of the doubt on a lot of things. That could be your metrics. That could be maybe you don't generate free cash flow yet. Maybe your costs are too high. Once you're a public company, you don't get any passes for any of those things. So you have to have very strong financial metrics or a plan to get there. And you have to be able to explain your company to public investors. And most of them are not very technical. So you have to paint that vision very clearly of what you're building without a lot of jargon and mumbo jumbo, which I know some folks have a tough time with.
Mm-hmm. That makes sense. So I'm hearing that storytelling as well as predictability seem to be the two key pieces and pillars. When a company is going public, they should have these things nailed down. But any other lessons that you've learned as companies transition from growth to IPO? What else do you think a company might need to make this transition successful?
Yeah, I think a lot about companies that I've been involved in that have gone public. So one very interesting example is Palantir. I wasn't an institutional investor, but I was a private investor in the company. And the company went public. It wasn't a very good outcome by most measures. It was positive, but it wasn't a blowout outcome. over the last few years, they've just predictably performed as a business. And I think the stock price has gone from, $8 or $10 a share to kind of $35 to $40 a share. I think the fact that they have had consistent performance, they've continued to expand their TAM by adding new products, getting stronger on every major metric. So whether that's Rule of 40, revenue retention, free cash flow, revenue per employee, all the things that show that you're a healthy company, they have just improved on every one of those aspects. And as a result, they were recently added to the S&P 500, which is just, it's an incredible to see that journey, even from quite a bit of a distance. And I think it's a really good example of what it takes to succeed as a public company.
Yeah, Palantir is a great example. And some of the metrics that you mentioned about Rule of 40 and ARR, net new ARR, do you think that these metrics would still apply as AI becomes more ubiquitous? And for AI applications, are there new metrics that software investors are looking to track?
Yeah, I think every once in a while and in every way, people try to tell you that the rules are different this time, and maybe you don't have to generate free cash flow sometime in the future. I mean, our view is in the future, however long that is for your business, all companies are just the present value of future cash flow at some level. To build an enduring generational company, there has to be an ability to generate large amounts of cash flow. Now, you may have a longer purview on that, and that may happen in 10 years versus 2 or 3 years. And that's okay, but there's got to be the possibility of that. So your foundation has to be good. Your margins have to be good. Your net retention has to be good. All those things still have to be strong because the physics of business don't change whether you're in AI or in SaaS or something else.
That makes sense. And when you're investing in these companies that are really paving the way for the new AI world that we're going to live in, such as Scale AI or Anthropic, when they're investing so heavily in infrastructure and all of their compute costs, what made you confident that these bets would pay off? And were you at all concerned about the high valuations that they had in the first place? And how do you think about risk and reward, like that profile of these companies?
Yeah, absolutely. I think valuation always is a consideration. You can invest in a great company and invest at the wrong price. I think that is definitely possible. That said, you don't also want to get stuck in a valuation trap because what tends to happen is the best companies get the highest valuation because it's obvious to the market that they're doing incredible things and that there's huge upside potential. So you want to be cognizant of valuation and price, but maybe not over-index on it so much. You kind of have to think through what the potential is of that company and where it's going and how it's going to expand its opportunity over some period of time. And then you can kind of justify or not justify the valuation that is being offered. We think, to your question about risk and reward, we think a lot about asymmetric risk and reward. And really what I mean by that, and what's definitely true in the venture growth equity business, is you can only lose 1x your money. That's the good news. But if you're right, you can make 10, 20, 30 times your investment, even at the growth stage. Our framework usually is, do we think this has asymmetric upside? For the risk we're taking, do we see a 5 or 10x outcome plus that kind of expansion growth stage for what we're doing? Because in most of these situations that they're solid companies, as you probably know, VCs have preferred stock and they have liquidation preferences and there's a waterfall. So even if things don't go well and it's an M&A scenario, you may not get all your money back, but you hopefully get some percentage of your investment back. But if you're right, then it's an asymmetric bet. So it's something we think a lot about, kind of those dynamics on risk reward.
Yeah, definitely. I feel like with high risk, there's always high reward. And VC is, I think, the classic example for that. But one of the biggest risks with AI today is around the ethics space. And I strongly believe that there's a growing conversation around ethical implications of AI. As an investor, how do you think about the promise of growth with responsibility and to ensure that the AI that you're funding does not lead to unintended consequences?
Yeah, I think it's a really important question. I think safety, privacy, and ethics are important both from what it means for the world, but also from a good business perspective. And what I mean by that is I think it's good for business as well to be aware of those things. And so for us, Anthropic is a classic example of a company that was built from the foundation to focus on safety, ethics, and privacy. And so it's set up as a benefit corporation, which really optimizes for those things. And our view is if you go to a company, let's say it's Disney as a potential customer, they care about these things and they want to make sure that the model that they're feeding, that the API that's driving communication with maybe children that are ages 18 to 14 years old is something that has lots of guardrails around it to protect everybody, and that folks are not able to engage with it in appropriate ways. And I think that's very important and it's good for business.
To be mindful and sure that the information you're spreading is actually not a hallucination. Maybe for some of our listeners, would you have any tips and tricks on how they can stay ahead of emerging trends in the technology landscape? As a VC, I'm sure that you're living and breathing the latest and greatest tech innovations, speaking of founders, but maybe how could some of our listeners be abreast with what's next?
Yeah, I mean, as VCs, our jobs are in a great degree of it is just being like a learning machine. And that means there's a lot of cognitive load at any given moment, but it's a lot of reading, it's a lot of podcasts, it's a lot of talking to entrepreneurs, customers, partners, because they really educate us on what's happening, what's coming, what's moving in the market. I think it's a combination of, it's a lot of listening. Most of the work is really just listening, taking that information and then using kind of your muscle memory to come to some kind of conclusion about what you believe is the opportunity or what's going to happen next. I would just say consume high quality content. That's the best way. And use your network to talk to experts in the field and get knowledge.
Mm-hmm. That's fair. And do you have any suggestions for sources of high quality content?
Yeah, I mean, I would say certainly podcasts like this, and I think there's several really focused on individuals that are in the technology space, whether that's entrepreneurs or venture capitalists. And I can certainly name some, 20 VC comes to mind as a really exceptional one, but there are many others that I listen to. And I think you get the insights from people in the field who are building products and building companies. And I think that really gives you a sense of maybe where the world is going.
That's fair. And do you think for people who are aspiring to break into VC, listening to public market earnings calls would also be helpful? Or do you think the podcast is the better route?
Yeah, it's certainly helpful. And we definitely do look at notes from those types of kind of public earnings calls and things like that. I think it's very helpful because what we're seeing in AI, which I think is a bit unique, is the big companies are definitely not asleep at the wheel. They are very much on top of what's happening, and they're driving a lot of value in the marketplace. This feels very different than other transitions, like let's say .com, where Barnes and Nobles or Borders or pick your company was probably asleep at the wheel for what was coming with Amazon. That is not happening right now. So it's a very different dynamic. And I think there is a lot to be learned from these earnings calls as well.
Mm-hmm. And then maybe from your vantage point, what excites you for the next decade of technology, where things are headed, in any sectors from an investment perspective that you're leaning into, apart from maybe AI or specifically within AI, if there are any subsectors that you think are exciting?
Yeah, we invest in the entire ecosystem of AI. And so that's at the most basic level, that's at the chip level, all the way to kind of the application layer. At every level of that stack, I think there are interesting opportunities. And that could include things like robotics. We're seeing, for example, what Tesla is working on, the humanoid robots. I, for one, use Tesla's full self-driving almost every day. And I've had it take me on 3-hour trips with no interruption. So I think the level of these technologies is getting to a place where it's going to have serious impact on our lives in the coming years. I mean, let's say you don't have to drive anymore. You have a humanoid who's doing a lot of your housekeeping and other house-related activities. You're just going to see a world where your time is really freed up to pursue other things. And hopefully those are passion projects versus doing kind of things that have to be done. So I think that's the kind of, I think, where we're headed. And it's just a question of what the timing of that is, which nobody knows. And I'm certainly not somebody who would claim to be able to predict the future. But I think generally what's going to happen is going to happen. And then nobody knows exactly when.
Yeah, that's fair. I remember seeing the Figure AI video of the humanoid robot making the coffee using the Keurig machine. And I was thinking to myself, what if it was just a regular coffee machine that made it by itself on voice command? Like, what's the difference between those two technologies where it's just the machine brewing the coffee versus a humanoid robot actually walking, picking up the pod, placing it, shutting the Keurig machine, and then the coffee coming out?
Yeah, I think it's going to be both. I think all these devices are going to be AI enabled and they'll know what you want. And then probably the humanoid will bring it to you, but it'll be made for you. So I think, I mean, based on what we've seen, that can be done at very basic levels today. And this is a question of when it becomes mainstream.
Yeah, ubiquitous. And voice command, like AI seems to be taking voice commands very well and understanding different accents and stuff. So that's pretty awesome. And it's exciting to see where the world is going to. Shifting gears a little bit, I want to talk more about your relationships that you formed over the last 2 decades with founders, boards, and other investors. How do you cultivate and maintain all these relationships, especially when things in the industry are moving at such a breakneck speed?
Yeah, and it definitely is something that's very deliberate to build and maintain relationships. I would say the thing that helps the most, from my perspective, is just keeping my and our word and our promises to people time and time again. I think if you have a track record of doing that over and over again over a period of time, good things happen and good people get part of that network who do the same and they reciprocate. And then you have this ecosystem of people who are just helping each other and driving each other forward. And that's what really creates these unique opportunities that we sometimes get, which is these aren't opportunities that we just call a company and suddenly, yes, we can invest. These are based on relationships, oftentimes over a decade or two, that somehow manifest themselves into influencing that company to let us invest and be their partner, because the best companies have a number of options for who they can take money from and who they can partner with. So I think you need to do the right things for a long time and just be alert and awake when opportunity strikes to move very, very quickly.
Yeah, could you share maybe a time when a key relationship made all the difference while you were trying to make a deal?
Yeah, I mean, I would say it happens almost every time. Maybe a recent one is Anthropic. So we had a relationship and have a relationship with the first business hire at OpenAI. And that individual had worked very closely with the team that ended up spinning out of OpenAI and forming Anthropic. And so after that spin out happened, because this individual knew us really well, they recommended us very highly to the team, and we spent time with them and kind of convinced them that we were good partners. And that's what led to an opportunity in a situation that was incredibly oversubscribed. I mean, there's no lack of capital interest in investing in the company, even back then. And this was a couple of years ago. So I think, and I could go on, but I mean, I think it's the case with almost every company we've invested in that something like this happened and some key relationship gave us an opportunity to participate.
Yeah, and I'm sure it goes both ways because you have the base level trust when you're transacting with someone you've had a relationship with before as well. You're probably more comfortable when you're kind of evaluating this opportunity since you know the person on the other end. or it's been recommended by someone
Exactly.
you've worked with previously. And for some of our founders who are listening on, could you talk about some of the key qualities that you look for when you're partnering with the founder, when you're choosing someone to work with?
Yeah, I can talk about having kind of done this for 18-ish years. One of the common threads we see on some of the really successful entrepreneurs that we work with, I would say the first thing that comes to mind is that they all tend to be learning machines. And what I mean by that is business is moving extremely fast, especially in the technology industry. And if you aren't learning and evolving your thinking in the areas of your technology, your management style, your products, your sales process, it's just really hard to keep up with the changes that are happening. I think that's kind of the number one. And I would say number two is entrepreneurs that are really good at selling. And I would say both selling to customers, but also selling to employees and executives to recruit them. Because recruiting tends to be a huge portion of the value of the CEO and founder, which is just getting the right people in the right seats who can build the company. So you just have to be very convincing to get people. You might be kind of an unproven startup and you're taking people from some of the big tech companies in the world and asking them to take a significant risk with you and take a risk of their career. And you have to be really convincing. I've just seen that again and again. The third thing that comes to mind is the companies that these very strong entrepreneurs start aren't typically the companies they end up with. And what I mean by that is they're really good at continually pivoting in the market. And as a result of that, they're kind of increasing the TAM of the opportunity. So they're really good at, you start with something core and then you keep adding products, features, opportunities that increase the TAM and increase the size of the overall company. And we've just seen that again and again from kind of these generational founders is they're always looking at the next thing and able to pivot and add to what they're already doing.
Yeah, and when these founders are looking to pivot, they obviously are taking a bigger risk, and the founder's journey is always so difficult because whenever you're changing what you've started off with, there's obviously risk involved with that decision.
I think that's right. But another way to look at that is by not taking the risk, you're also taking a lot of risk.
Yeah.
Because if you are just going to do the same thing you've been doing, markets are going to change and somebody else is going to come and take that opportunity. So not doing something is a risk too. So that's the way we kind of frame it.
Yeah, that's a very valid point and a good way to think of things when you're on the fence about making a change. You need to ride with the times rather than go against the tide. But a lot of these founders need to be very resilient and have the ability to persevere. How is that something you measure when you're meeting with a founder and trying to understand where they're coming from?
Yeah, I think one thing to look at is their background and upbringing and their obviously professional experiences. I'll give you one example in our portfolio. So Rubrik is a kind of data cybersecurity company. The founder of that company actually is a Wharton alum. His name is Bipul Sinha. And he's got an incredible story, an incredible journey of, I would say, resilience. He grew up in a small village in India with no running water. He kind of worked off his bootstraps to get into IIT, came to the US, went to Wharton, worked in Silicon Valley. Based on that background, got into venture capital and then started a company that is now a major public company that's about to hit $1 billion of ARR. You can see that, and as part of that journey, has just recruited some of the best executives in kind of SaaS and software in the entire industry. You can just imagine the number of things he has overcome in that long journey. And I think if you have somebody who's come from that background and gotten that far, that gives you a very interesting data point on what their upside potential is.
Yeah, definitely. I mean, as an immigrant founder, being able to run and scale such a large company is extremely inspiring. And I hope that some of our listeners who are afraid to take a plunge, like look at his journey and get inspired to go out and start. And given that you've been in the space for over 18 years and you've worked with a lot of founders, what are some of the common mistakes you've seen founders make when they're working with investors, and any suggestions on how they can avoid them?
Yeah, I would say the number one thing I see is around transparency with your investors. And I think the best relationships are ones where you're a partner with the VC firm and you don't treat the VC firm like they're part of some governance committee. Obviously, this is a two-way street and both parties have to look at it similarly. But I think the best VCs and the best founders understand that they kind of need each other and they should be helping each other succeed. So, from a founder perspective, the more you share, I think the more you will get in return, the more you'll get out of your investor. And I think it's okay to be vulnerable as an entrepreneur when they're already an investor and tell them, hey, these are issues we're going through and we need help, and really engage those investors versus sometimes what you see is everything is kind of hunky-dory and everything is going really well. And the entrepreneur doesn't want to disclose all the difficulties. They just want to present a rosy picture because you're an investor. And I don't think that's a productive approach because then you can't engage them to help you.
Yeah, that's very fair. And I mean, if they've already subscribed to your company by investing in you and your company, it's better to use them as a support system. What's the best advice you'd say you've received that you'd like to pass on to our listeners today?
Yeah, I think one of my mentors very early told me that in business, just focus on creating win-win situations and be okay with leaving a little bit of money on the table.
Mm-hmm.
And at the time, I didn't really appreciate it. But as time has gone on, I think I've tried to do that. And the result has been that you get into relationships with people, both people are getting value and both people are probably leaving a little bit of money on the table.
Mm-hmm.
But those relationships then compound over very long periods of time because everybody is happy with how things are going. Everybody's getting value from it. And I think most businesses, at least our business, is driven by compounding great relationships over long periods of time and deepening those relationships and doing lots and lots of things together. I think that starts with creating win-win situations from the get-go.
Yeah, it's important to grow the pie, especially in a field like VC where there's so much uncertainty and room to grow. So I'm sure everybody will get a large slice as long as people are working together and, like you said, being transparent and supporting each other. Are there any messages that you'd like to leave for aspiring founders today?
Yeah, I would say it's so hard to be a founder that only do it if you can't imagine not doing anything else. It's got to drive you to such a degree that you just can't imagine doing something else with your career. And I think those people tend to be the best founders.
Mm-hmm. And for aspiring VCs?
Yeah, I think for aspiring VCs, I think the industry is really driven by high quality deal flow and proprietary deals. So leverage your network, find opportunities that not everyone is seeing, and share those with people you want to work with. And I think that's how you prove that you can do something unique, right? It's not, I can create the best spreadsheet or analysis or PowerPoint. I think the industry is very different than other industries where your network tends to be your biggest asset. And if you can use that to create unique opportunities for somebody, they will pay attention to it.
Mm-hmm. And finally, for those exploring careers in tech?
I would say get into AI as soon as possible. Clearly, I'm biased, but I remember when I was in business school, obviously a lot of people were going into banking, consulting. I think in the future, there could be a bit of a rude awakening for those types of industries because the AI tools that people are building today, I mean, there's a number of things we're seeing that are focused on replacing those types of roles, at least at the more mid to junior levels.
Mm-hmm.
I think with the tools that are coming, I'm not sure that those careers are going to be as robust. I'm not saying they're going to go away, but I think instead of hiring 10 consultants, you might have one really good one and a lot of AI tools. I think the number of opportunities in those industries are just going to change. And it makes sense to lean into tech so that you don't find yourself in a difficult situation.
Yeah, that's fair. I read this quote somewhere. It's like AI isn't going to take your job, but some person who uses AI tools will. So better to upskill and
Exactly.
yeah.
AI is leverage. Basically, you can do a lot more with one human than you could do in the past. And that means companies will just hire fewer people.
Yeah. And for our last segment for today, we have a quick rapid fire round. I'm going to ask you a few questions and I'd love to learn a little bit more about you. So, my first one is, what's the most unexpected hobby you've picked up since you starting in VC?
Yeah, probably pickleball, because I think that's something that VCs and founders seem to love and certainly didn't exist when I started in VC. So I used to be a tennis player and I never imagined I'd be playing this kind of truncated version of that sometime in the future.
Yeah, when I was in the Bay Area, everybody was obsessed with pickleball. They had a court right next to my house, and it was impossible to get a slot unless you reached exactly at 6 p.m. when the court opened. I totally relate with that. What's the craziest use of AI you've ever seen?
Nothing feels crazy anymore. I would say, since we were on this topic, there's a company recently that just got funded by Khosla called Rogo, and they're actually using AI to replace kind of hedge fund and private equity analysts. And they have a bunch of customers, and this is already happening. And again, replace slash enhance, but over time, there's going to be attrition in those roles if you have a lot of technology. So maybe not crazy. I mean, we don't rely on these investment memos, but we use AI to create investment memos just to see what it does. And it's getting remarkably good. And once it knows how you typically like to structure them and what you focus on, it can do something very similar. And it's like more or less in 30, 60 seconds. Maybe that's one of the most, or at least from my perspective, one of the most unexpected uses of AI.
For sure, faster, cheaper, better. Like, why wouldn't people use it? So that makes sense. And what's the most underestimated trend in AI that you think people aren't paying attention to today?
I think it's AI driven services that are going to be targeted at knowledge work industries. Most of the attention's been on foundational models and things like that. But I think there's going to be this very significant services layer. One example that a lot of people know is a company called Harvey AI, which is a legal focused AI company. But I think there's going to be a bunch of those basically in every professional services industry. There's going to be a AI-driven services industry that's going to sprout up in accounting. We're seeing it in software development, consulting, etc. So I think people are not maybe as focused on that because it's not much of a shiny object, and VCs traditionally don't focus that much on services. But I would call this kind of tech-enabled services, and it's a major opportunity in my view.
Yeah. And is there a company you passed on that you wished you hadn't?
Yes, there are many. I would say there are probably two that maybe hurt the most. One was DoorDash at about a 600 million valuation. I think my math is correct. Today they have a $58 billion valuation. So not taking into account dilution, you can probably do some general math on what that would be. And then the other one was, even though I invested in it personally, I never made an institutional size investment in Palantir and knew the folks in around that company for a long time. So I think I probably could have invested in a $2.5 billion valuation or something like that at a growth expansion stage. And now that company is 83 billion in the S&P 500. Considering the amount of change in value, you could definitely put that in as a miss.
Yeah, that's fair. But you win some, you lose some. And I know you've made some great deals over the years. So I think you can give yourself some grace. This is my second to last question is, what's one tech company that you think everyone is sleeping on today?
Clearly, I'm biased. Rubrik recently went public earlier this year. I think the company has immense upside from where they are today. And company's approaching about $1 billion in ARR. And I think the market hasn't quite figured out how big this business is going to be and how good of an entrepreneur Vipul Sinha is. And so I think they have a long way to go, but It's the fastest growing SaaS company in the public markets right now, or at least in the top couple. And I don't think the market has quite figured that out, how unique it is, what they have built, and how much more TAM there is for them to capture.
Wow, that's incredible. I'm excited, definitely gonna follow that journey. And lastly, what is your go-to productivity hack when you're deep in investment analysis?
Yeah, so for me, the best productivity hack, I try to do at least 1 to 2 power hours every day. And those are times when I turn off the phone and other communication and just focus on the most important tasks. And sometimes that's deep work that just requires a lot of thinking. And so you don't want the constant pings and disruptions and calls. So you just turn off all communications, lock yourself in a room, and just do deep work. And I think if you do that for 1 or 2 hours a day, it makes a real difference.
The power of compounding, right? And then it becomes a habit and part of every day. Well, Ish, that's all the questions I had. I just want to say thank you so much for joining us on the podcast. It was fascinating to hear your thoughts, your journey, and really learning from an industry veteran in the VC space. I'm sure all of our listeners are going to enjoy this podcast and be super grateful to you. So thank you for your time.
Yeah, thank you so much for having me. This has been a lot of fun, and thanks for giving me an opportunity to tell my story.